Have you ever wondered what truly separates a successful investor from someone who just speculates on the market? Benjamin Graham, the legendary investor and mentor to Warren Buffett, argues that the key difference lies in the approach you take. In the first part of The Intelligent Investor, Graham explains that investing is about focusing on long-term, steady growth, while speculation is all about betting on short-term market movements without understanding the underlying value of a stock. The intelligent investor, Graham says, is not swayed by market fads or the excitement of quick gains, but instead looks for intrinsic value, stability, and a reasonable margin of safety. Graham emphasizes that to truly succeed as an investor, it's crucial to differentiate between investing and speculating. Investing is about careful analysis and making decisions that protect your capital while generating consistent returns over time. Speculation, on the other hand, is driven by chance and short-term predictions, often leading to higher risks and volatile outcomes. One of Graham's powerful quotes from this chapter is, "The essence of investment management is the management of risk, not the management of returns." The key takeaway here is that investing isn't about making quick profits. It's about reducing risk and aiming for gradual, reliable growth. When it comes to inflation, Graham explains how it can eat away at the value of your investments. Inflation means the purchasing power of money decreases over time, so it's essential for investors to make adjustments to their strategy. Graham suggests that inflation should not be ignored, but rather factored into investment decisions. He stresses the importance of diversifying your portfolio with an emphasis on stocks and real estate, which have historically outpaced inflation. Graham's words here are a stark reminder. Inflation is the one form of taxation that can be imposed without legislation. The actionable insight is clear. To protect your wealth from inflation, ensure your investments grow at a rate that outpaces rising prices. In this part, Graham also takes us through a century of stock market history, offering us a long-term view of market trends and behaviors. By examining how stock prices have fluctuated over time, investors can better understand the cyclical nature of the market. It's essential to recognize that short-term market fluctuations often lead to irrational decisions, but when viewed from a long-term perspective, the market's behavior becomes much clearer. As Graham wisely puts it, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. The lesson here is to remain patient and not be overly reactive to short-term market swings, trusting that over time the value of your investments will align with their true worth. Graham then introduces the concept of the defensive investor. This type of investor seeks stability and security, prioritizing the preservation of capital over the pursuit of high returns. The defensive investor is not interested in speculation or risky ventures. Instead, they favor a more conservative approach with steady, predictable returns. Graham writes, "The defensive investor is one who is primarily concerned with avoiding serious loss of capital." This reinforces the idea that investing should be about risk management, not taking chances on high-risk stocks or strategies. Even defensive investors can still incorporate some stock investments in their portfolios, but Graham advises selecting stocks that are stable, well-established companies with a strong history of profitability. These are the kinds of stocks that provide steady dividends and long-term growth potential. He stresses that defensive investors should not chase after the latest hot stock or fad, but focus on well-run companies that offer a good balance between risk and reward. The true investor is not interested in speculation or in the future price movements of securities, but rather in their future income-producing capacity, says Graham. This underscores the idea that even conservative investors can benefit from the stock market if they choose their investments wisely. For those willing to take on more risk, Graham offers advice to the enterprising investor. These investors are more active and are willing to do their homework, research, and take calculated risks for the chance of higher returns. However, Graham cautions that just because you are more active in managing your portfolio doesn't mean you should act impulsively. He says, the enterprising investor should seek to outperform the market, but only after a careful analysis of the market and the investment's intrinsic value. The lesson here is that active investing requires discipline and patience, and it should always be driven by thorough research, not speculation. Market fluctuations are inevitable, but Graham encourages investors to remain rational and not be controlled by their emotions. He introduces the concept of Mr. Market, a metaphor for the irrational behavior of the market. Mr. Market, according to Graham, offers prices for stocks that can often be driven by emotions like fear and greed, and it's crucial for investors to see these fluctuations for what they are, temporary. Graham famously says, the investor's chief problem, and even his worst enemy, is likely to be himself. The takeaway here is that emotional decisions based on market volatility can be disastrous, and investors must stay grounded in their strategy, even when the market is turbulent. Finally, Graham discusses investing in mutual funds. These funds offer a way for both defensive and enterprising investors to diversify their portfolios with professional management. Graham advises that when selecting a mutual fund, it's crucial to choose one that is well managed and has a low expense ratio. Mutual funds can provide broad diversification, a key factor in reducing risk, and help investors access professional expertise. As Graham says, a well-managed mutual fund can offer an investor broad diversification and professional management, two key factors in successful investing. In this part of the book, Graham teaches us how to approach investing with a long-term mindset, prioritize risk management, and stay rational even when markets are volatile. Whether you're a defensive investor or an enterprising one, the strategies outlined here offer a solid foundation for building wealth over time. By sticking to these principles, you can navigate the market with confidence and avoid the pitfalls of speculation and emotional decision-making. Part 2 of The Intelligent Investor focuses on the defensive investor and common stocks, providing a deeper dive into the concept of investing for the long term with a focus on stability and safety. This section outlines the practical steps a defensive investor can take to create a diversified portfolio that includes common stocks, stocks of large, well-established companies that are considered relatively safe compared to more speculative investments. Graham discusses how the defensive investor can benefit from the stock market by choosing stocks with a track record of stability and predictable earnings. He emphasizes that the defensive investor does not seek speculative, high-growth stocks, but instead chooses those that can offer steady, long-term returns with lower risk. The key is diversification, which Graham argues reduces risk by spreading investments across various assets and carefully selecting stocks that are fundamentally sound. One of Graham's core principles is the concept of a margin of safety. This refers to purchasing stocks at prices that are lower than their intrinsic value, providing a cushion against market downturns. The defensive investor focuses on building a portfolio that ensures long-term growth while avoiding the potential for significant losses. He says, the most important thing to remember about investing is that it's not about predicting the future, it's about managing risk. The actionable insight here is clear. A defensive investor should focus on diversification, choose companies with a stable earnings history, and invest in stocks when they are priced lower than their intrinsic value, always keeping a margin of safety in mind. By applying these strategies, the defensive investor can navigate market fluctuations without putting their financial well-being at significant risk. Additionally, Graham addresses the importance of bonds in the defensive investor's portfolio. Bonds can provide a steady income stream and act as a buffer against the volatility of the stock market. A balanced portfolio that includes both stocks and bonds allows the defensive investor to manage risk while still having exposure to potential stock market gains. This chapter emphasizes the idea that the defensive investor must always act with caution, balancing growth and safety in a way that ensures long-term financial security. Lastly, Graham touches on the importance of sticking to a well-thought-out plan and avoiding emotional decisions. When faced with market downturns or volatility, it's critical for the defensive investor to remain disciplined and avoid panic selling. The defensive investor's success hinges on their ability to stay calm and focus on the long-term objectives rather than reacting to short-term fluctuations in the market. In essence, Part 2 highlights how defensive investors can balance risk and reward by choosing stable, blue-chip stocks, diversifying their portfolios, and ensuring a margin of safety in all investments. It offers a methodical approach to stock investing, reinforcing the importance of patience, discipline, and long-term thinking. Part 3 of The Intelligent Investor shifts focus to the enterprising investor, someone who is more active and willing to take on greater risks in order to achieve higher returns. This section offers valuable insights for those who have the time, knowledge, and willingness to put in more effort to manage their investments. The enterprising investor takes a more hands-on approach compared to the defensive investor, and this part outlines the principles and strategies for such an investor to navigate the stock market. Graham begins by emphasizing that being an enterprising investor does not mean taking reckless risks or relying on speculation. Instead, it's about finding opportunities for value and growth that others may overlook. He discusses the importance of doing thorough research, studying financial statements, and evaluating the intrinsic value of potential investments. The enterprising investor's goal is to identify undervalued stocks that have the potential for long-term growth. Graham's advice is clear. The stock market is filled with individuals who know the price of everything, but the value of nothing. This quote encapsulates the enterprising investor's need to focus on the value of investments rather than just their current market price. The actionable insight here is that enterprising investors must be diligent in their research, paying close attention to a company's financial health, growth prospects, and market positioning. By identifying undervalued stocks, they can take advantage of market inefficiencies and purchase stocks that have the potential to outperform the market over time. Graham also addresses the need for diversification in the enterprising investor's portfolio, though in a different way than the defensive investor. While the defensive investor seeks broad diversification to reduce risk, the enterprising investor can afford to concentrate their investments on fewer, higher potential opportunities. However, even for the enterprising investor, Graham advises against putting all their money into speculative stocks or over-concentrating their portfolio. The key is to strike a balance between risk and reward, focusing on a few solid opportunities rather than diversifying too broadly. One of the main strategies for the enterprising investor is to consider special situations, investment opportunities where the market has mispriced a stock due to temporary factors such as mergers, acquisitions, or corporate restructuring. These situations often offer the enterprising investor an opportunity to purchase stocks at a discount, taking advantage of the market's short-term irrationality. However, Graham warns that entering these situations requires careful analysis and a deep understanding of the specific company's situation. Graham also touches on the importance of bond selection for the enterprising investor. While the defensive investor may rely more heavily on bonds as a safe part of their portfolio, the enterprising investor can use bonds to enhance their returns by purchasing higher-yielding corporate bonds or other fixed-income securities. These investments offer more risk than government bonds, but can provide higher returns if chosen wisely. The enterprising investor must also manage market fluctuations, though in a more active way than the defensive investor. Graham notes that while market volatility can present opportunities, it can also lead to greater risk. Therefore, enterprising investors should be prepared to weather short-term fluctuations and adjust their portfolios based on new information or market changes. As Graham puts it, the intelligent investor is a realist who sells to optimists and buys from pessimists. This advice highlights the need for contrarian thinking, buying when others are fearful, and selling when others are overly optimistic. Finally, Graham reminds the enterprising investor that success in the stock market is not about relying on luck or market timing, but about using a disciplined approach to identify value, minimize risk, and make informed decisions. The enterprising investor must avoid following the crowd and focus on making rational, well-researched decisions based on the fundamental value of the investments. In summary, Part 3 of The Intelligent Investor provides a roadmap for the enterprising investor, emphasizing the importance of careful research, a focus on value investing, and the management of risk through diversification and intelligent decision-making. The enterprising investor who follows these principles can potentially achieve higher returns by exploiting market inefficiencies while keeping their risk exposure under control.